The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Hello, I'm Brian Akers from Akers Financial Group, and here today I have with me Jeff Akers, also from Akers Financial Group. We're both certified financial planner practitioners. Just been in the industry about 22 years, and here this morning we're going to be talking on winning in retirement. Good morning, Jeff.
Good morning, Brian. I've been at it 22, but you've been at it about 10 years longer than that.
Yeah, I had to get a running start, you know. It's always good. All right, so today's show has got to be information that's incredibly good and information that you're going to want to go to our website at akersfinancial.com to hear more about it. Now, what we're talking about is something that is always a part of a good retirement plan, no matter what age you are. It's something that many people forget to do. And you know what that is? That's to make sure that she is protected in case you don't live to save for your own retirement. So the title of what we're going to call the show is Make Sure She is Protected.
Right.
This applies to everyone, though. It applies to each spouse and making sure that if we cannot fully fund their retirement because we're not there, we have the proper vehicle, the proper amount of life insurance to fund that side of the retirement equation.
Right. So I'm married, and I want to make sure that my wife is going to be taken care of if I'm gone, if something happens tomorrow. You just don't know.
Right. So the key planning tool is this. Imagine you're going to call a financial planner, and you just happen to call Akers Financial Group, and you come in for that first meeting, and you're like, I don't really want to talk about death. Not at all. But then we say, well, it's all part of the retirement plan. And the idea is this. Let's plan as if we might die tomorrow. Will your spouse be okay? Is she protected to provide and reach every goal and dream you guys have together without you? Is that possible?
Right. So we have a retirement plan where the husband and the wife are working together to build up some assets for retirement. But then something happens. One of them passes away. The other one, how are they going to make up for what the now deceased spouse was contributing? And that's where life insurance can come in.
Life gets complicated. The more we have a family, the bigger our family grows, the more debts we have, the more assets we accumulate. Things get more and more complicated. And what happens is that life insurance delivers a death benefit upon a death. That life insurance is income tax-free.
Tax-free.
It's a check that comes, or a money market that the money gets put into within a few weeks. It's an immediate amount of cash that lands into that family's life to provide at that moment it's greatly needed.
Right. So it can take care of those things that the person was dealing with from their income. And now it's being taken care of through the life insurance.
Right. So this show is called Make Sure She is Protected. So we're going to talk about life insurance. Yes, life insurance. The idea here is this. Many times life insurance is sold to someone in that you're like, oh, I'll buy it. It sounds good. The idea is we want you to examine the why. Why are you buying life insurance? And make sure because of the why that you're buying life insurance, you're buying the right kind of life insurance, the right policy. We're going to consider life insurance to be just a tool to reach our financial goals. Imagine that financial goals, I want to achieve my goals if I'm alive or if I'm not alive, both. Life insurance helps meet that shortfall if I don't have the time to save that money for the future years. So life insurance is a key ingredient to a retirement plan, no matter what age we are.
That's right. So we're going to talk today about what about if you're younger? What kind of life insurance do you need there? As we get older, what kind of life insurance do we need there? We're going to try and educate you a little bit about the process of getting life insurance, figuring out how much you need. And like Brian said, what kind? Because there are different kinds of life insurance out there. And so we want to be smart about what we get to meet those needs.
Life insurance matters to the one that receives the check. Let me try to explain a little story that happened in my career, let's say 15 years ago. There was a call on a Sunday night saying that from a spouse saying that her husband had passed away. With him passing away, she didn't know she's going to make it financially and didn't know what to do. And I said, let me come to your house tomorrow morning and I'll explain the plan that we did and why it's going to work and give you many choices. And then the next day I went to her house And I went through the basics. I mean, it's a very upsetting time when a spouse dies, especially at a young age. At 55 was this person.
Right.
And so what happened is that sudden death in the planning is before retirement. And so there wasn't that 10, 12 more years to save and grow and build a pension and all these things that you always assume in retirement planning. That, oh, life expectancy 90, we're going to live that time, we're going to need this much money, let's grow at this rate, and everything's fine and dandy. But then you look, hey, let's cut off the funding source, the whole funding source. And so the reality is I sat down with her and I went through the death benefit need that we did as part of the original plan. And we said, well, we have life insurance through work and through this policy here, and we'll get a check in a few weeks. The reality is the plan we talked about is that you might not be able to stay in this house, but you don't have to sell it tomorrow. We can spend a year or two to decide and get ready so we can make wise decisions and not be in a hurry. That is what life insurance should do, is to provide the financial stability. Now, when somebody passes away in a family unit like that, it's still emotionally hard, right, Jeff?
Oh, absolutely. And like the situation you're talking about, it came up suddenly. It's kind of unexpected. And we have those cases where we don't know what tomorrow is going to hold. And if someone has 10 years, they're planning on retiring in 10 years, so like you were talking about in this situation, and they're planning on saving this much money over that 10-year period, but now the funding source is gone.
Right.
And so the life insurance comes into play to take care of that funding source and the planning that you did in advance.
Yeah, what I don't like is when people just get it through work, and then the thing is that people change jobs so often that it's not portable, it doesn't go with them, and when they retire, it also just stops. And one of the things I've seen in my career is that if you are disabled and they put you out on total disability, your group benefit stops also.
Right. So now you don't have the life insurance that you had.
Even if you're terminally ill as part of your disability, the group benefit doesn't automatically go with you.
Yeah, so we obviously don't want that. And you've got situations, you mentioned people changing jobs a lot. I can't tell you how many times I'll ask someone, so what kind of benefits do you have through work? I don't know. And so we have to go and find out what kind of life insurance they have.
You can imagine, let's say you get a job, you're single when you get the job, and then you grow your career, you find someone, you fall in love, get married, and then you have, the house, the big fence, a dog, and then you have kids after you have the dog, and you start growing debts, and you've never looked at your group benefits again to realize, did I get one-time salary or two? What should I do? And then all of a sudden, the reality of life hits in, and you're like, I think I might need insurance. And then the question would be, Jeff, is where do you start trying to help someone like in that phase of life, figuring out how much to buy?
All right. Well, I'm going to go back for a second because one of the first things I'm going to say is you got this job with this insurance before you got married. Who's the beneficiary? Let's make sure that's current and up to date.
Yeah.
But then we need to look at, okay, now you've got other needs, other responsibilities, and how are you going to protect your spouse in that? So we need to take a look at what are your debts, what kind of support or income are you providing to the family? And then what's it going to take to match that or meet the need of your wife if you were to pass away?
Right. And so if you just think about it and you think about the amount of debt you have, death benefit of life insurance should be higher than the debt you owe at least.
Right.
So at least there'll be no debt. The reality, if there's a one income earner, you need more money. Mm-hmm. If there are two income earners, you still got to realize how much you're spending and what's the need for income. And that's a whole calculation that can be done. Some old school planning was 10 times your salary would be a good number. So if you make $100,000 a year, you might need $1 million of life insurance to be able to fund the most expensive times of life. So trying to build this out is really a very important piece. So what happens is that if we think about if we passed away tomorrow, what would you want to see happening? So the death benefit would come in, and then the spouse would then, let's say, pay off the debt so that the bills would be lower, and then have some extra money to provide income as they look to the future.
Yeah. And I'm just thinking about the house. You've got two income earners, you've got a mortgage, and maybe one spouse, their salary is going to pay for the house, and the other one's taking care of groceries or whatever, and then one passes away. Well, it kind of doesn't matter which one passes away. You still got to make the mortgage payment, and you still got to buy your groceries and stuff. So we need to cover both folks in that case.
Right. So every scenario, whatever your scenario is, you take your budget, where your money's going, and imagine that one of the income is stopped. Right. It could be because of disability or it could be because of death. And if it's a sudden death like this, what do you do? Well, the life insurance, of course, has to be in place prior. It's not something, well, you don't get a redo. You don't get I wish I checked that box. Can I go backwards? The idea is when we're the most healthy is when we got to make these decisions.
Yeah, the best time to get it is when you're young and immortal. At least you think you're immortal.
So the idea of winning in retirement is you want your spouse, your family to win in the retirement years. Now, we all want to live in our retirement years and want to enjoy those retirement years. But the reality is that some people might not make it all the way to retirement. And we got to plan to make sure that the rest of your family makes it to retirement financially, and they're not going to be in a lot worse shape because you didn't check a box or didn't buy the right amount of life insurance when it was time for you to buy it.
Right. Part of planning is planning for the best, but at the same time, planning for the worst case scenario.
All right, and as we go through life and we pay down our debts, the need for life insurance might go down for the immediate need. It might change on your why and why you need life insurance. You might say, oh, I want to give money to my family. I want to pay the tax on all this money I've accumulated. I want to provide money to charity. These might be your new why in those retirement years, and that would mean life insurance, because of the tax-free benefit, can truly give you a bang for your dollar, money that comes tax-free to whoever you put down as your beneficiary.
Yeah, so one of the things that we'll be talking about is different kinds of life insurance. What kind of life insurance do we need to cover a debt like a mortgage? What kind of life insurance do we need that's going to be there to take care of that kind of that legacy planning like you're talking about?
You can't tell the secrets on the rest of the show too early.
I'm sorry.
Yeah. All right. So, yes, we're going to talk about life insurance and the different kinds of life insurance. And what's important for you guys to understand is this. You need to know why you need it first. Once you know why, then we can talk about how much and then how to pay for it. Bring in those three aspects together will give you the right decision on life insurance. Don't just buy what you're sold, buy what you're presented. Buy what you and your family need. You sit down with a financial advisor and you make sure that you're making the best decision. Now, at Acres Financial Group, we're independent. We're local. We don't report to a big company on Wall Street. We report to you. We have offices in Lutherville and Forest Hill and clients all around the country. But what we do is we sit down with you and talk about what makes you and your family be able to win in retirement. So for a free consultation with one of our team of advisors, give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting. Go to acresfinancialgroup.com or give us a call at 833-946-7384 to start planning for your retirement now. Should you rent or buy your life insurance? We'll talk about this in the second quarter in just 2 minutes.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Yes, welcome back to Winning in Retirement. I'm Brian Akers, and here with me today is Jeff Akers. We're certified financial planner practitioners from Acres Financial Group. Right here in Maryland, we work with clients all around the area and a bunch are all around the country in many different states now as their clients retire and start to move different places. Now, Jeff, we welcome you to second quarter, Jeff. We've been talking about make sure she is protected when it comes to life insurance and making sure we have the right kind of coverage. So this show is all about that and understanding what life insurance is all about. The question as we left quarter number one was, should you rent or buy your life insurance? So Jeff, as you start second quarter, tough question. What's your answer on this one?
Well, it's really going to depend on the situation. What are you trying to cover or protect against? When we say renting life insurance, we're talking about something called term life insurance. And that's the one that you hear commercials on the radio all the time about getting so much coverage for so much money or whatever.
Right.
It's the cheaper version. But you got to understand there's a time period, and if you live past that time period, then you no longer have life insurance. So it's to cover those things. I think of a mortgage being a prime example. A mortgage, you got a 30-year mortgage. At the end of 30 years, if you've done it correctly, you no longer have a mortgage. So you don't need that life insurance to cover that debt any longer once the 30 years is up. So term insurance makes sense for that kind of need that you might have.
Yeah, so the word term insurance has no cash value. It's a guaranteed premium that you pay, and then the insurance company would owe a death benefit if you die within that term. Now, generally, term insurance is you can buy what they call yearly renewable or annual renewable, or every year the price can go up. but it just keeps going, and they'll show you a projected where the prices go a little bit up every year. And over the last decade and a half or more, they've been more 10 and 20-year, 25-year, 30-year term policies where you buy them and you have a flat rate for that whole 20 to 30 years. And then when that period's over, the premium goes up so high that you end up just canceling it.
Right. Yeah, even that annual renewable, you get it when you're young and you're like, oh, this is great. And then 10, 15 years later, you look at it and like, man, what am I paying for my life insurance now?
Yeah.
Getting a term policy where the premium is guaranteed and level for that entire term can be a good thing, especially as you get towards the end of the term.
Some of the things we don't know about our work, you might not notice on your paycheck, is that every 5 years, your group term insurance goes up. And when you start hitting 40, 45, 50, each one of them, it really jumps on you, and you start paying more and more. They actually use unisex rates. What does that mean, Jeff?
They don't take into account whether you're a man or a woman.
And so who does that hurt?
That hurts women because women tend to live longer, so the cost of insurance for them is less at the same age.
So group term insurance for women is probably one of the wrong things that you should do because you're going to be paying too much for the insurance. What you got to do is plan out your life on the death benefit side, buy insurance on your own. So no matter what job you have insurance that covers your family and the situation that you're in.
All right. When you get it through work, you don't have to worry about underwriting. That's how healthy are you, that kind of thing. When you buy it on your own, a lot of times you will have to go through underwriting. They're going to check your doctors and things like that and make sure that you're healthy enough. And so if you're pretty healthy, odds are you're going to get less expensive coverage outside of work.
Over a period of time.
Over a period of time, yeah.
Now, the trick on the group benefit is when you sign up for the job, you're covered with guaranteed insurability.
Right.
But if you wait and then say, oh, it's time for me to up it, and you go back to them, they'll then make you fill out forms, and then you have to be insurable at that time.
Right. I had a case a little while ago where a guy, he needed life insurance. We figured out the amount that he needed and everything, and it was going to be to cover mortgage and debts and that kind of thing. So term was going to work. And we went ahead and applied. He had some medical issues, and so we sent that information off to insurance companies, and they just came back saying, well, we're not going to cover him, or it's going to be rated and it's going to cost more. Well, his open enrollment was coming up at work, so we said, okay, we're going to go to the work insurance, and that's what we're going to get because we need to cover this need right now. Now, if his health status changes over time, then we can always go back and apply for the term insurance later. But for right now, we've got the coverage that he needs through work because it's guaranteed issue through work.
Was it a new job or it was guaranteed issue even at the open enrollment?
It was an open enrollment period for him. It wasn't a new job, but this was one of those cases where he didn't check the box initially.
Yeah.
And so we looked at his insurance need and said, well, you need it. So,
but the company's plan allowed him to buy it.
Yeah, the company allowed him to buy it at open enrollment. It wasn't just a new job, and so you get to...
Right, so you need to know your company benefits to make sure what you have offered, what the premium is, and does it fit properly. When you look at your paycheck, see what's coming out. See why it's coming out. Yeah. Make sure you're covered. I believe when the younger we are, we got to check the box on group benefits, short and long-term disability. You got to buy some life insurance through work, but you got to buy the rest on your own so that you can plan that out. Possibly a 20-year term fits really well. Right. Now, the opposite of renting is actually buy something that builds an equity or cash value. And what is that, Jeff?
So cash value life insurance are several different kinds that you might have heard about over the years. The oldest was whole life. And with whole life, everything is guaranteed. Your premium is guaranteed, the death benefit's guaranteed, the interest rate inside is guaranteed, the cash value is guaranteed. But whole life is a way to put money into an insurance product and build up some cash value over time that later on you could take money out of even and use loans or something like that, and then that's tax-free while you're alive. Now, that's one kind of permanent insurance. Some other kinds are called universal life, and there's variable universal life and fixed index universal life. They all have, the differences all have to do with how the interest, if you call it interest, is calculated inside the policy. When you get the variable universal life, then we're talking about sort of investing in stocks and bonds and stuff, which that can put you in a bind when markets go down. So we need to be careful about what we buy, what it's covering, and what's truly guaranteed.
Right. So term insurance is going to last a certain period of time. A permanent policy, a cash value policy, is charging you more up front and taking that extra money and building up a savings account, which will then allow this policy to last a lifetime.
Yep.
And so if you have extra money the younger you are, it might make sense to have some permanent that'll last a lifetime so that no matter when you pass away, there's a death benefit. Because there is always need for money when someone passes away, from funeral costs to paying taxes to who knows what other situations going on.
Right. We just don't know what's going to happen down the road. And so having that permanent coverage with the cash value, you can even reach a point where enough cash builds up inside the policy where you don't have to pay the premiums anymore, and it's going to last until you pass away.
So when you're thinking about savings and building up money for your future, life insurance can be a tool that could work for you. So our show today is called Make Sure She's Protected. We want to make sure we're providing for our spouse for whatever the need may be for income and debt, and that's death benefit. But life insurance, especially permanent life insurance, can cover a few other things. It can provide for things such as long-term care needs. It also can provide for if you're disabled and you need more income, you can pull the cash back out tax-free. There's a lot of options that these tools provide. So, Jeff, when you think about life insurance and the permanent policies, there's a lot of options that can go on. What are some examples of things that you've seen?
Well, I'll just give a personal example for myself. I got a variable universal life insurance policy a long time ago when I was young, and it was cheap. And just put money into it every month. And then 10, 12, 15 years later, I was married and we were in the process of adopting and we needed some money for the adoption. Well, I had this life insurance policy with some cash value buildup that I could take a loan from and use that money towards the adoption. And so I did that, and then I didn't have to, but I just started repaying the loan on the policy. And so I still have the policy today. I've still got the cash value. The loan's paid off and everything. So it was one of those things where it's money you can use. It can even be part of your emergency fund, which is something else that we talk a lot about in planning, because you can access it, and it's tax-free when you access it, as long as that policy stays in force.
Right. And so the other thing that's been used heavily recently is the idea as you get closer and closer to retirement, your concerns go from death, but also to disability, where you go to the hospital and you're told that you need to go to rehab or to some type of special care where you need to take it, be at home for home health care, assisted living, or even nursing care. And people are like, well, regular long-term care policies are just incredibly expensive and the price goes up. Doesn't seem right. What is the other choice out there? And what happens is life insurance with a living benefit that provides some of that benefit early to provide for home health care, assisted living, or nursing care could be something that fits very well in retirement years. So someone as early as 45 to 50 can, instead of having life insurance just to pay the mortgage, can have a type of life insurance that helps meets multiple needs down the road.
All right. And I'm going to back up a little bit and say, well, what if you're young and you're making quite a bit of money and you're thinking, well, how can I save this? But then you get to, you want to retire before 59 and a half. Well, all your retirement accounts, you got to wait until you're 59 and a half. Life insurance will allow you to use that cash value in there before 59 and a half without a penalty and without tax. So it's kind of like what the Roth IRA is, but you can use a little bit earlier. You don't have to wait for 59 and a half.
Yeah, and we're going to cover the tax-free benefits in the third quarter in just a few more minutes. But right here, as we finish up the second quarter, life insurance, buying or renting, the idea is if you buy permanent, imagine it's like buying a house where you buy the mortgage, you build equity. If you're renting and you buy term insurance, basically you don't own anything. There's no return of money. You're just sort of betting that you might pass away during that period of time. And the insurance company says, we agree that you might not pass away, so we'll take your money. And so that's why term insurance can be so cheap, and that a lot of people do survive that 1 year period of time. So when you're trying to make decisions on how to protect your family, you have to think about why am I buying it, how much can I need, how much do I need, and then you got to figure out how to pay for it. The renting is going to be a lot cheaper, and those are different term options. When we talk about permanent insurance, it's going to cost more, and sometimes a lot more, depending on what you want it to do for you. If your why is trying to cover for the worst case scenarios in your own life, such as long-term care and those debilitating times of life, what you got to do is have cash value policies designed to cover all those things. And the reason that Acres Financial Group wants you to know about these life insurance options is that in retirement, your biggest worry should really be about where you're going to drink your morning cup of coffee, not about having everything handled, making sure that every scenario, every worst case scenario is handled by your financial plan that was drawn up by your team of advisors at Acres Financial Group. If you want a future that is designed with you and your family in mind, begin with a financial plan through Acres Financial Group. To begin doing that, you'll also begin to win in retirement. You can meet with one of our team of advisors by giving us a call at 833-WIN-RETIRE. That is 833-WIN-RETIRE. We'll call you on Monday to schedule a free in-person Zoom meeting, or go to acresfinancialgroup.com. Okay, go ahead and give us a call at 833-946-7384 to start planning for your retirement now. Do you want your family to receive a tax-free check when something happens to you? We will explain in 2 minutes as we begin the second half of Winning in Retirement.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I am Brian Akers, President and Founder of Acres Financial Group. And here with me today is Vice President of Acres Financial Group, Jeff Akers. Good morning, Jeff.
Good morning again, Brian.
That's the second half. I just want to make sure you wake up, because in the second half of our show, we got to get going because there's so much to cover when we build these shows. We have a lot of information in our topics. Our topic today has been make sure she is protected, which is a very important topic for your family as you think about and work on your retirement. Why is it so important, Jeff?
Yeah, the first thing in my mind when we're doing financial planning is protecting the family. We want to make sure that your wife, your kids, whatever, they're protected. And life insurance is an important way to protect your family against some sort of catastrophe that can happen.
Yeah, so our advice is this. Make sure you know why you're buying it, how much you need, and then the best thing is trying to figure out how to pay for it. Are you going to rent it, buy it? How are you going to use your money to provide this death benefit? Now, making sure she's protected is because in planning for retirement years, we got to plan in case we're not around to save for those retirement years. Now, the opposite happens when it comes to some people in their financial life, and that is they max out their retirement plans at work, but because they have a very nice income, but they can't save any more, and they're looking for more ways to save to build for a retirement. They're not eligible to put money to a Roth IRA, so they need another solution. And so this topic is about the idea of having your family receive a tax-free check when something happens. And what I mean by that is that tax-free check could be death benefit or retirement income. And Jeff's here to try to explain this to us. Jeff, okay, the idea is this, tax-free from life insurance. What does that all mean?
Yeah, so I started this in the second quarter, but you can use the cash value in a permanent life insurance policy. You can actually use that as loans tax-free during retirement. It's a great feature that you can use, and you plan for it early on when you buy the policy because you got to fund it enough so that you build up the cash value. But then when you get to that age where you need some money, you can use the tax-free loan coming from the policy. And as long as the policy stays in force, you don't have to worry about ever paying taxes on that. So that's a way to use your life insurance while you're still living. There is a death benefit. When we think of life insurance, we just think about the death benefit and, it's only good for when I die. Well, that's not true. There are ways that you can use that while you're living tax-free. And the example that Brian was talking about, where you earn too much money, or you may have, reached a point where you just can't put any more money into your retirement accounts. This is another vehicle you can put money into that then builds up a cash value that's tax-free to access.
All right, many people listen to multiple radio shows. We know you do it. You don't just listen to Winning in Retirement. And so on podcasts, on the web, everywhere, you'll find a lot of advertisements about tax-free retirement income. And Roth IRA is one option where you have to save and work at that. The other vehicle or tool that's used is life insurance.
Yep.
So why do many of these shows never mention the tool life insurance, Jeff?
Well, I think they're looking at it two things. One is you think about life insurance, you think what I just said, well, I got to die for anybody to benefit from it. And that's not true. So I think that's one reason, because people kind of shy away from the term life insurance.
I think the more they learn about how life insurance works, they can understand that, wow, this would be a great fit in my situation. I should do this. And one of the best ways I try to explain is, imagine you have a house. You've been paying on your house. You're building equity in your house. If you built the equity in your house and you want to access that, you get a home equity loan. Is that taxable?
Well, when you get a home equity loan, no.
It's not taxable. Imagine a life insurance policy. You build equity in a policy. That policy is there. It's your money. You can withdraw your original money back out tax-free.
Yep.
And the growth, if you borrow against it like a home equity loan, it's tax-free.
Yep.
It's just like the house combinations. That's a simple idea of how you take withdrawals is through withdrawals and loans against a policy. And then when you pass away, the loan's paid off and settles out all tax-free, and so that you've built a tax-free benefit over a period of time.
Right. The loan is paid off, and there's a death benefit that still goes to your beneficiaries.
Absolutely. So life insurance has costs to it. Imagine you're on a train. You have your train, and the train's going to make a couple stops. Life insurance has to pay for the cost of mortality, the cost of the death benefit piece, and that's normally the term cost. And so when you talk about a permanent policy that builds up cash value, you have to have more premium than what the mortality costs are. All the administration fees inside, you got to know what they are. And premium tax that's included inside. These are all hidden costs inside. And then the money above that goes to a side fund. And that's the difference between the kinds of policies. Is this train that stops at mortality, stops at administration, then stops at that side fund and delivers to the side fund extra cash, and then that's invested for your future. The more excess cash you put in, the more it gets to the side fund, the more it grows tax-free and can come out tax-free.
Yep, we call that side fund the cash value of the policy, and that's what you can access.
And it can earn guaranteed interest. It could earn dividends. It can be invested tied to an index with a downside protection, or it can be invested in sub-accounts like mutual funds that can go up and down in the market, depending on what kind of policy design you might choose.
Right, and so that's one part of tax-free is, yes, you can use the cash value tax-free while you're alive. The other tax-free part is the death benefit, and the death benefit is tax-free to those beneficiaries. So, we've, through our career, we try to help people defer taxes, put taxes off. And, one of the ways that we do that or might do that is through an annuity that's non-qualified. Well, somebody eventually is going to pay tax on that money. And so when you pass away and you leave that to your beneficiaries, they get that chunk of money, but they're going to have to pay tax on the interest. When we use life insurance, that builds up over time. When you pass away and that's left to your beneficiaries, there is no tax. There's no tax to be paid. So we like using the life insurance when you can qualify for it, when you can get it, and when it fits. But we have to look at your specific financial fingerprint and make sure that it's going to fit for you.
Have you had a case recently that worked very well?
I had a situation where somebody had a non-qualified annuity, and we were thinking, okay, well, let's just keep it tax-free and change it over. But the wife was very healthy, and so we applied for life insurance, and she qualified. She was super preferred, super healthy. And so we were actually able to annuitize the annuity and then use that payment that came out of the annuity to pay for the life insurance policy for 10 years. We got a policy where we said we're only going to pay for it for 10 years, and then it's going to last as long as she does. It's a permanent policy. And then when she passes away, that death benefit is going to pass to her kids. Let's say that the annuity was worth like $150,000, and the death benefit we got was $450,000. So it's going to be worth a lot more, and that lot more is all tax-free to the beneficiaries.
Tax-free, that's a big deal. Imagine that if someone receives $1 million 401k plan, they have a 10-year period of time to take it out. Most likely, that's $100,000 a year, and in most situations, a minimum of 22% federal, and here in Maryland, 8%. So 30% of that money is gone. So the $1 million IRA benefit is actually worth $700,000 at that 22% bracket.
Yep.
That's not assuming there are any brackets even any higher or taxes go up. Life insurance, $1 million. What does the beneficiary receive, Jeff?
$1 million.
And do they get a 1099 for the tax return?
No, they get $1 million.
Right. So the $1 million is real. It comes. I had a situation where the client had a client's father had built a stock portfolio and then had built a IRAs investments and then built life insurance to cover any taxes that might happen down the road. And so what ends up happening was that they had the money come in. Now, the guy lived a lot longer than expected. He was like almost 90 years old. So the kids were like 70 years old or almost 70. And they're like, well, we don't need all the money that he's providing. It's wonderful. But that tax-free benefit was $250,000 to each of his 3 kids, which each kid got to decide how to use it. And they started giving money to the next generation from that death benefit right away. So it helped multiple generations by having a tax-free benefit in that situation. It was just a really neat thing to see that the life insurance piece of the component wasn't taken away from the investments. It wasn't making the IRA disappear. It's just using some of the interest, some of the money is provided to buy the life insurance, which created a tax-free benefit that is truly helping this family. 2 of the 3 ended up giving a rather large gifts to their kids to help buy houses, pay down debt, and really build college funds for even the next for the grandkids. Or that guy who passed away, his great-grandkids' college fund was coming tax-free out of that.
Right. And then when you think about legacy like that, how do you want to be remembered? For this fella, his great-grandkids are going to remember his name because he paid for their college.
Yeah.
So, I mean, that's a wonderful legacy to pass on.
Yeah, I mean, you think about it. We want to be remembered. If you think
Fondly.
if you think about like trying to remember who your great grandfather is, your great great grandfather, it's hard to remember a name because you never met him.
Right.
But the reality is that if someone makes a legacy plan, it can really, really matter, and it can matter for generations. I really love it when it comes down to charity. Life insurance and using other things for charity can be a great combination. One of the coolest combinations is to give your retirement and taxable accounts to charity, and then you create the life insurance to help your family receive tax-free through something like a wealth replacement trust. Yes, it sounds complex, but the idea is this. There are lots of ways to use the tool of life insurance. When you're trying to make sure that she's protected for her retirement years, and if you pass away immediately, you got to understand the why. Why are you doing it? Why do you need life insurance, and how does it fit? As we go through this process of understanding who you are and what your family needs, and life insurance as a tool might fit when it comes to all of your goals and dreams. The thing is that life insurance can be designed in a plan rather than sold to you. It can become part of the ultimate answer that you and your family have been looking for. So the key thing is this, is understanding life insurance as a tool to make sure that she's protected now and all the way through, which I think is a wonderful thing to do. The reason that at Acres Financial Group we do this is because during your retirement years, the best part of retirement is truly getting your time back, where you decide how to use it. Before retirement, your time is tied up with other commitments, mainly your job. A lot of that goes away in your retirement years. Your time is now consumed by things that you want to do. It's so easy to begin winning in retirement. Go to our website at acresfinancialgroup.com, scroll to the schedule a meeting section, and let us know you'd like to schedule your free consultation with one of our team of advisors. That's acresfinancialgroup.com, or you can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting. Go to acresfinancialgroup.com or call us at 833-946-7384 to start planning for your retirement now. If you're still in the saving money for retirement mode, life insurance may still be needed. Why? We'll talk about this in 2 minutes.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Or shake the keys, it's a key quarter, that kind of stuff. A lot of colleges do that. But the idea is this, in the fourth quarter of a show, yes, you got to bring it better than ever. You got to tie it all together so because those listening can really understand what we've been trying to cover today.
Yeah, we hope that works for you.
All right. So you're awake, Jeff?
Yeah, I'm awake.
All right. So in the fourth quarter, we're coming in with this question. That question is, if you're still in the saving mode or saving money for retirement mode, life insurance may still be needed. Explain what the idea is there.
So you're saving for retirement, and let's say that you're $500,000 away from your goal. That's how much you want to have saved up for retirement. But now you pass away. Well, that $500,000, where's that going to come from? So if you're still saving for retirement, that means you haven't met your goal yet. What are you going to do to meet that goal if you don't survive?
Right. So I'm going to make sure everybody understands that we're talking about saving for the retirement of the surviving spouse, because you don't have to save for yourself anymore because you passed away, right?
You can't take that with you, but your surviving spouse can either remember you fondly or remember you not so fondly.
As they have to work to 80 years old because there wasn't any life insurance.
Right.
So that's why we named the show. What did we name the show, Jeff?
Something about protecting her, making sure she's protected.
Make sure she is protected. So I'm sorry. It's a little bit, we're trying to make it a little bit funny, but understand this, that if we don't have life insurance and we're short on retirement, we basically are shorting her retirement if you passed away. Or in the other case, if in both cases, if you're both not covered, then whoever survives is the one that's going to be short on retirement and have to work longer.
Yep. And now, thankfully, with our clients, we explain the need and we get them what they need. But sometimes folks will come in and they'll say, well, my husband just died. What am I going to do? Well, he didn't have life insurance. He didn't have savings. And so we've got to figure out, sometimes big changes have to be made at that point. When we do a plan the right way leading up to that time period, then we don't have those issues that we have to confront.
So life insurance should be treated like a tool. It's a very important tool that we can help cover the fears, the concerns we have during our lifetime by buying the right kind for different times of our life. And so we've talked about on the show about term insurance. We talked about cash value, permanent insurance. Talked about life insurance that's for tax-free retirement. Talked a little bit about long-term care benefits that come off of it. But knowing the purpose behind the life insurance helps you design what you need to do, what you need to buy, and make sure you have the right policy in place.
All right. So life insurance is a tool. We've said that, and it has a purpose. And so you'd use the purpose to figure out what we need to get. That tells us that purpose is going to tell us how much life insurance that we need, and it's going to tell us what kind we need to get.
Absolutely. Now, life insurance, when you are buying it on you, you're like, it doesn't really matter because I'm going to be dead. I don't need that life insurance. And so life insurance becomes an act of love, right, Jeff?
It is an act of love because it's providing for your spouse, for your family.
Right.
Yeah. So like I said before, I'm married. I want to make sure that my wife is taken care of if something happens to me.
Do you want to make her wealthy?
She doesn't have to be wealthy, but she needs to be able to get by. She needs to have a place to live.
Right.
And she needs to be able to take care of herself, to pay for her bills and groceries and things like that. So she doesn't need to be left bogged down with any debt. She needs to be in a position where she can just take care of herself.
But don't you have Social Security for something like that?
Yeah, well, Social Security was never intended to be what people live on. It's always been intended to be like a little supplement, just a little extra to help. And so Social Security is not going to be enough, whether we're talking about your retirement. You know, sometimes people come in and say, oh, I'll have Social Security. Okay. And you'll live at the poverty line.
Right.
That's all you're going to have. So it's the same thing. And in some cases, worse when someone passes away and the surviving spouse is left with just Social Security to try and survive on.
Well, in your case, your kids are too old to receive Social Security now because they're out of high school.
Yep.
So there is no Social Security benefit for kids that are in college.
Yep. They're on their own.
They're on their own. They might qualify for financial aid because nothing's coming in, but they're not going to be eligible for Social Security. Your spouse is less than 60, so she would also not get a widow benefit until age 60.
Right.
So Security, you might think, oh, that'll cover it. That she'll be fine. Doesn't really need it. And in reality, it's like, well, maybe not.
Right.
I remember one case where we had a husband die suddenly, and the kid was, I think, 15 years old. So I tried to explain year by year how we're going to get Social Security income to provide, and then there's going to be a couple year gap on the savings plan for her to draw a widow benefit at 60. Try to get there financially. So we had to save some of the death benefit to fund those 2 years, because the ability that the spouse had to earn money was not really great. There wasn't, she couldn't go out there and make what her husband was making. And so we designed a plan just to meet her needs and get her into age 60 to then draw Social Security. It was a tough bridge to try to build.
Right. So there's the planning ahead of time, which is, okay, he had some death benefit, he had some life insurance,
Right.
but then there's the planning after he passes away and how to make sure that we cover the income for all of the years in there. And you can't just magically say, oh, well, when you're 60, you'll be fine. But I'm 50 right now.
Yeah, well, this is a case where my client had said, "Can I help his sister? His husband just died," and so we come in after the fact, and we got to try to create the answer with what we have there, what tools that are left there. So the hard part in financial planning is, yes, we do get called in after the fact, and we try to work with what's there. The reality is, if we could do planning from the person's first day of work, you can build a plan that has everything in place.
Right. So just think if you're 20, 30, 40, even 50, come see us. Let us figure out what the right thing is for you, figure out your financial fingerprint. And when it comes to life insurance, it's a tool. Let's evaluate it. Let's see if you need it, how much of it you need, and what it's going to take to protect your family and protect your future if we are going to use that tax-free benefit for loans and stuff in retirement.
Yeah, so the tax-free life insurance, I think using your money and saving it allows people to retire early and also allows us to retire at a higher income level if we're able to build this money. The harder parts, if we look at ways of saving money, there's only so much you can save in retirement plans at work. What you have to do is truly, truly look at where your money's going and see if there's any ways to build tax-free. If you max out Roths, you max out at work savings, normally there's no other place to go. But life insurance, if the younger you are and you have time to let it grow, I think life insurance growing tax-free could be a scenario that you might want to look into.
Right. So again, it's a tool. Tools have purposes. Let's make sure that we're using the right tools to meet your goals long term.
All right, so people are listening to the show and they're like, life insurance, can you break it down to me? So life insurance, how do we get life insurance? What's the process, Jeff?
All right, so I'm going to talk about if we're going out and getting it on our own. First, we look around and shop for what's going to be the best
They call Acres Financial Group.
Oh, I'm sorry. I'm jumping ahead. I've already assumed that they called us because clearly we're going to help them through this process.
Right. Go ahead.
Okay, so we're going to shop around. We're going to look for the best company, the death benefit, what you need and everything. And then the first step in that process of actually getting it is we do an application. We take that application, we send that into the insurance company. They're going to have a nurse or someone come out. They're going to ask a lot of questions, get information from doctors and stuff like that. They're doing what's called medical underwriting, checking to make sure how healthy you are, because the insurance company needs to know that in order to determine what the cost of insurance is going to be. They're going to make a decision. They're going to let us know what that decision is, and we're going to decide yes or no whether or not we want to go with what they've decided when it comes to the cost for the life insurance. Then there's a policy that comes out. We have to pay the premium. Now that's going to come in next. Now, sometimes you can pay the premium when you do the application, and when you do that, then you have some coverage from the time you applied if they were going to approve you anyway.
How does that work?
Well, sometimes you need life insurance and you go ahead and send in the check for your first year's premium, even though they haven't approved you yet. And so if they approve you, then you've already paid your first year's premium. If they don't approve you, they send you the refund check. But in the meantime, if you were to pass away while they're doing the underwriting, then if they were going to approve you anyway, then your beneficiary gets that death benefit.
So you're actually buying the coverage.
You're buying the coverage sort of in advance.
Yeah, so basically at Acres Financial Group, we serve as brokers shopping insurance through many different companies, many different sources to provide a policy that will fit the situation. Yep. And the reason that we've been independent and have stayed independent is so we have the ability to make a choice on what fits and what's best in every scenario. And so it takes time to shop this out and to get the right kind of policy. Many times if you try to do it yourself online, what you'll find is that they'll give you an incredible great rate. And the reason is they might run you at something called super preferred. What does the word super preferred mean, Jeff?
It means you are super healthy. There's not a thing wrong with you. You don't take any medicine. And, as far as the insurance company is concerned, you're going to live a really long time.
And there's a body build chart.
Yes.
So our healthier clients don't even fit the chart because Basically, you need to be a certain size and height and weight. Yeah.
Okay, so I don't qualify, but
on the chart. So the hardest part about life insurance is life insurance depends on how you are, and it's an individual thing. It's a tool we need to purchase, not be sold. We need to think about why we're buying it, how much, and then how to pay for it. Bringing that all together to make the wisest decision when it comes to life insurance.
Right. So you want to know what it is that you're getting. Don't just buy whatever someone's trying to sell you.
Absolutely. And the reason we're doing this show is we want you to think about this. Make sure she is protected. Protected for a case where you might pass away. Now, this might be your spouse. It might be make sure he is protected. But the idea is this. Do you have the proper amount of insurance for death benefit? Or have you thought about using life insurance for its other reasons, its other purposes, the other ways that tool can be used? It's very important for you to think about all that. If you miss any part of this show, you can go to our website at acresfinancialgroup.com. On the website, you hit the radio tab. You can see the show right there. You can listen to it again, different parts about it, and you can find out more about life insurance and about why it's so important to make sure she is protected. All right, Jeff, excellent job today. We want to thank everyone else for listening to our show. We also want you to win in your retirement by taking advantage of the opportunity to begin planning with us at Acres Financial Group. To schedule your free meeting with one of our team of advisors, go to our website at acresfinancialgroup.com. Scroll to the Schedule a Meeting section and let us know you'd like to schedule your free meeting. That's acresfinancialgroup.com, or you can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting with one of our team of advisors. Start planning for your retirement now. Go to acresfinancialgroup.com or give us a call at 833-946-7384. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Akers Financial Group offers securities through Archedios Capital, an SIPC and FINRA member firm. Advisory services are provided through Archedios Wealth. Akers Financial Group and Archedios do not share any common ownership. Neither Archedios nor Akers Financial Group provides tax or legal advice. Advice given on Winning in Retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, and or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment. Examples and scenarios shared are meant to be for illustrative purposes only. Past performance is not indicative of future results.